Here's a brutal truth that will sting. You're not losing money because you pick bad stocks. You're losing money because you don't know how to take profits. While amateurs chase every last penny of a move, professionals follow a counterintuitive rule that Jesse Livermore used to extract $3 million from a single wheat trade in 1925, equivalent to $50 million today. This single principle separated the greatest speculator in history from the countless traders who died broke, and it's the exact opposite of what your emotions tell you to do. You've lived this nightmare. Your position rockets 30% in your favor. You're feeling brilliant. Greed whispers, "What if it hits 50%? So you hold. The market reverses. Your 30% winner becomes a 10% loser. You exit defeated, wondering what separates you from the professionals who seem to extract maximum profits from every major move. The answer isn't mystical market timing or insider knowledge. It's a systematic approach to profit management that most traders never learn because it feels completely wrong. Here's the amateur mindset. Hold winners longer, cut losses later. The professional knows something different, something that goes against every instinct you have. Livermore discovered that managing winning positions is exponentially harder than cutting losses. Why? Because fear makes you sell quickly, but greed makes you hold until you give it all back. Fear is immediate and sharp. Greed is patient and seductive. When you're losing money, your brain screams, "Get out." When you're winning, it whispers, "What if there's more?" That whisper destroys more accounts than any market crash. Most trading advice gets this backwards. Everyone preaches, "Cut losses fast, let winners run." But what does "let winners run" actually mean? Hold forever? Hope for the best? Pray the trend continues indefinitely? Livermore's real edge came from a systematic approach to both taking profits and building positions that most traders have never heard of. He called it his 1/3 rule, a dual-purpose system that protected his capital while maximizing his upside on confirmed trends. This wasn't feel-good psychology. This was mathematical precision, applied to market chaos. This wasn't just theory. In 1907, Livermore learned the hard way when improper pyramiding nearly destroyed him. He lost everything: his fortune, his reputation, his confidence. Young traders today make the same mistakes. They average down on losers. They hold winners too long, hoping for perfection. And they risk too much on single trades. But by 1925, Livermore had perfected a method that allowed him to take profits systematically while building larger positions only when the market proved him right. The rule transforms both how you exit winners and how you enter new positions. The wheat trade of 1925 demonstrates this principle in brutal clarity. Livermore didn't go all in on a hunch. He started with what he called a probe, a small test position to gauge market sentiment. When the market confirmed his thesis through price action and volume, he added systematically. As profits accumulated, he took money off the table at predetermined levels, protecting his gains before greed could destroy them. While other speculators either missed the move entirely or gave back their profits hoping for even more, Livermore extracted millions through disciplined execution. He didn't try to pick the exact top. He took what the market gave him and moved on to the next opportunity. Here's what separates professionals from amateurs in fluorescent clarity. Amateurs try to be right, big, fast. They want home runs on every swing. They risk large amounts hoping to compensate for previous losses with one spectacular winner. Professionals try to be right, small, then get paid to size up. They understand that individual trades don't matter. What matters is systematic profit extraction across many trades over time. They start with small positions. Let the market prove them right. Then gradually increase their stakes as confirmation builds. The psychology behind this approach reveals why most traders fail. When you're winning, your brain floods with dopamine and overconfidence. You start believing you can predict the future. You begin thinking this winner will solve all your financial problems. You hold longer than planned, risking more than intended, until the inevitable reversal wipes out your gains. Professionals understand that hope is not a strategy. They have predetermined rules for when to take profits and when to add to positions, removing emotion from the equation entirely. The one-third rule addresses both sides of this equation with mathematical precision. On the profit-taking side, it provides specific triggers for when to take money off the table, protecting your gains before greed can destroy them. You don't guess when to sell, you follow predetermined levels based on your initial risk. On the position-building side, it provides a systematic approach to scaling into positions, ensuring you only risk large amounts when the market has already proven you right through confirmation signals. You don't hope for success, you earn it through market validation. Memorize this. Amateurs try to be right big, fast. Professionals try to be right small, then get paid to size up. The market doesn't care about your bills, your dreams, or your account size. It only responds to supply and demand dynamics that create price movement and volume patterns. Your job isn't to predict the future, it's to react intelligently to present conditions with predetermined rules that protect your capital while maximizing your opportunities. By the end of this exploration, you'll understand why the one-third rule is actually two rules in one, and how both can revolutionize your trading forever. You'll see the exact mechanics, when to take that first third off, how to build positions systematically, and why this counterintuitive approach actually maximizes profits while minimizing risk. The choice is yours. Continue trading on hope and emotion like the 95% who consistently lose money, or join the small minority who extract profits systematically through disciplined execution of time-tested principles. Amateur traders hate taking profits. They see it as leaving money on the table, a cardinal sin that violates their deepest beliefs about maximizing returns. Professionals see it differently. They're buying insurance and creating ammunition for the next clean setup. The paradox is mathematically beautiful. You make more money over a year by taking less on each individual trade. Livermore's profit-taking version of the one-third rule transforms winners from fragile hope into durable wealth streams. It replaces the emotional roller coaster of greed and fear with mathematical precision that removes guesswork from your most important decisions. Start with concrete numbers that reveal the system's genius. You identify a promising breakout and buy 300 shares of XYZ at $100 per share. Before placing the trade, you calculate your maximum acceptable risk, $5 per share with a stop loss at $95. Your total intended risk is $1,500. This pre-calculation is sacred. It defines your pain threshold before emotions can cloud your judgment. Most amateurs skip this step entirely, which is why they consistently lose money. According to Livermore's rule, you don't wait for some arbitrary price target. Instead, you act when your profit reaches one-third of your intended risk. One-third of $1,500 is $500. When your total position profit hits $500, you sell 100 shares, exactly one-third of your position. This occurs at approximately $101.67 per share, locking in $167 of realized profit. Here's what just happened that most traders completely miss. You've created what professionals call a free ride scenario that fundamentally transforms the risk profile of your entire trade. Your remaining 200 shares now have a built-in cushion, a mathematical safety net that changes everything. Even if the stock collapses back to your original stop at $95, your banked $167 profit means you break even on the entire campaign. You've transformed a potentially risky position where you could have lost $1,500 into a risk-free opportunity with unlimited upside potential. The psychological transformation is profound. Before taking the first third, you're hoping and praying the stock continues higher. After taking the first third, you're playing with house money. The crushing fear of giving back profits diminishes because you've already secured gains that can never be taken away by market reversals. Think about the mathematical beauty of what you've accomplished. Your original position carried $1,500 of risk across 300 shares. After the first sale, your 200 remaining shares still carry $5 per share of risk to your stop, totaling $1,000 of potential loss. But you've banked $167, reducing your net worst-case scenario to $833 instead of $1,500. You haven't achieved a complete free ride yet, but you've manufactured substantial protection through systematic action rather than hope. The rule gets more sophisticated with the second profit-taking trigger. When your total profit reaches two-thirds of your original intended risk, $1,000 in this example, you take another third, selling 100 more shares. This typically occurs around $103.33 per share, banking an additional $333 in realized profits. You've now extracted $500 total, while holding just 100 shares of your original 300. Even a complete reversal to your entry price leaves you profitable on the entire campaign. At this point, you've reduced your market exposure by two-thirds, while maintaining unlimited upside potential through your remaining position. Problem: this approach feels deeply wrong to most traders. They watch the stock continue higher after taking profits and immediately feel like they missed out on potential gains. Greed whispers its poisonous promises about what could have been. This emotional trap keeps amateurs poor while professionals accumulate wealth systematically. Proof lies in your own trading history. How many times did you hold a winner too long, watching a 30% gain evaporate into a break-even trade or worse? How many times did you exit too early out of fear, only to watch it surge without you, cementing the belief that you should have held on? Livermore's method bypasses this emotional roller coaster by establishing clear, objective rules before the trade begins. The professional mindset focuses on aggregate performance across many trades rather than optimizing individual trade results. When you fixate on what you could have made, you ignore what you actually did make. When you focus on perfect timing, you miss the importance of consistent execution. The goal isn't to extract every penny from every move, it's to extract consistent profits from a series of moves while protecting capital from inevitable reversals. Protocol for the remaining one-third: it gets a trailing stop, typically 10–15% below recent highs or beneath significant technical support levels. This final position is pure gravy. You've already won the trade and secured substantial profits. Now you're just seeing how much the market wants to pay you for your patience and discipline. The trailing stop moves higher as the stock advances, locking in additional profits while giving the trend room to breathe. If the stock reaches $110, your trailing stop might protect over $600 in additional profits on your remaining 100 shares. Each profit-taking event creates cash that can be deployed into new opportunities. While amateurs tie up all their capital in single positions hoping for home runs, professionals create steady streams of available capital through systematic profit extraction. This cash flow provides flexibility to capitalize on fresh setups without closing existing positions prematurely. Memorize this maxim: the goal isn't to maximize profit on individual trades, it's to maximize profit over a series of trades while protecting capital. This distinction separates professionals from amateurs who optimize for single trade performance instead of system performance across time. But here's where Livermore's genius reveals its dual nature. He used the same one-third rule for building positions, not just exiting them. How do you know when to add to winners versus when to take profits? The answer lies in market confirmation signals and systematic position building that transforms speculation into disciplined wealth accumulation. Now comes the flip side: how professionals build positions without blowing up their accounts. This is where most traders get pyramiding catastrophically wrong, transforming what should be a wealth-building technique into an account-destroying nightmare. Amateur approach reveals itself in painful clarity. See a breakout, slam full size immediately. No confirmation, no plan to scale, just pure fear of missing out, driving maximum commitment at the first sign of movement. When the inevitable pullback hits, and pullbacks always hit, they're stopped out with maximum damage at the worst possible price. Their entire risk budget gets consumed by a single failed attempt, leaving no capital for the next opportunity. Professional approach operates on completely different principles. Start with a test position, exactly one-third of your intended total, and only add after the market proves you right, through price action and volume confirmation. Here's the exact protocol with numbers that remove all guesswork from implementation. Account size: $100,000, representing serious capital that demands professional management. Risk per trading idea: 0.75%, translating to $750 maximum loss per campaign. You identify a compelling stock trading at $50, breaking above a pivotal resistance point that has contained price for weeks. Stop loss placement: $48.50, risking $1.50 per share based on technical structure, rather than arbitrary percentages. Initial probe position, 200 shares, risking exactly $300, well within your planned risk envelope, and representing only 40% of your maximum intended risk for this idea. This first position carries sacred significance that amateur traders completely misunderstand. It's not a commitment to being right. It's a question posed to the market. Are you ready to move in the direction I anticipate? The position size reflects uncertainty rather than conviction. If price breaks back below your pivotal point, confirming that your analysis was premature or incorrect, you exit with a small, manageable loss that barely dents your trading capital. If the market confirms your thesis through sustained price advancement and expanding volume, you prepare for systematic position building that aligns your risk with market validation rather than hope. First edition trigger requires objective confirmation rather than wishful interpretation. Strong close above $51, with volume expanding at least 30% above the recent average. Not just any close, but one that demonstrates institutional participation and sustainable momentum. Ad size follows mathematical precision, approximately 1/3 of your current position, roughly 70 shares at $51.10. Your total position becomes 270 shares with an average cost of approximately $50.26. New stop placement trails to just below the pivotal point that created the confirmation signal, perhaps $49.80. Notice the beautiful mathematics. Your dollar risk actually improves on a per-share basis, while your position grows with demonstrated trend strength. You're risking roughly $351 on 270 shares from the $49.80 stop, compared to your original $300 risk on 200 shares. Second edition trigger demands even higher confirmation standards. Another breakout at a higher level, perhaps $52.50, with continued volume expansion and institutional participation. Ad size follows the same mathematical framework. 1/3 of your current total position, approximately 90 shares, bringing your total to roughly 360 shares at an average cost around $50.72. Each addition must be profitable immediately, or you don't make it. This rule prevents averaging down disguised as pyramiding up. Your new stop trails beneath the higher pivot at $51.20, risking approximately $547 on the full position, still well within your original $750 risk budget. Despite holding 80% more shares than your initial probe, consider this scenario that illustrates professional position building in action. A seasoned trader spots a $50 software stock breaking above a 6-week consolidation base with expanding volume. Instead of committing his full intended position immediately, he starts with 200 shares, small and manageable relative to his account size. The stock hesitates initially, trading sideways around $50.20 for 2 days, testing his patience but not triggering his stop. Then it climbs to $50.80 on expanding volume, showing the first signs of sustainable momentum. He doesn't chase this initial move. Instead, he records the behavior and waits for clearer confirmation. When price clears $51 with authority and volume expansion, he adds 70 shares systematically. His average cost rises controllably while his conviction grows through market validation rather than personal opinion. The psychological transformation that occurs through this process separates professionals from amateurs in profound ways. Amateur traders start with maximum conviction and maximum position size, then watch both erode as the market fails to immediately validate their analysis. Professional traders start with measured conviction and modest position size, then allow both to grow as the market provides confirmation through actual price and volume behavior. This approach aligns position size with market validation rather than personal opinion, creating a feedback loop where your largest positions are always in your strongest, most confirmed trends. 3. Principles keep this systematic approach safe and profitable. First, structure your additions around pivotal points that attract fresh institutional demand, not arbitrary round numbers or percentage moves. Second, scale smaller with each addition, so your pyramid remains broad at the base and narrow at the top. Top-heavy pyramiding collapses on routine volatility. Third, require immediate positive feedback from price action. If an addition doesn't show profit quickly, You cut that layer and reassess your thesis. Memorize this fundamental maxim that governs all professional position building. You earn size by being right. The market pays your raise. Position size isn't determined by your conviction alone. It's earned through market confirmation that validates your analysis through actual price movement and institutional participation. Waiting between editions isn't wasted time, it's risk management disguised as patience, ensuring that each scaling decision is based on market reality rather than emotional urgency. But here's the critical question that determines whether this systematic approach succeeds or fails. How do you protect this carefully built pyramid when the inevitable pullback comes? The answer lies in dynamic stop management that preserves gains while allowing healthy trends room to develop. Building a position is only half the battle. The other half, protecting it, separates professionals from the wreckage of amateur accounts scattered across market history. Livermore learned this lesson with devastating clarity in 1907, when poor stop management turned a winning cotton position into financial ruin that forced him into bankruptcy. He had been right about market direction, had built his pyramid systematically, but failed to protect his gains with disciplined exit management. When cotton reversed violently, his entire fortune evaporated because he hadn't choreographed his stops with the same precision he used for his entries. This brutal lesson shaped his later success. Without systematic stop-loss choreography, one red day can vaporize your carefully built staircase of profits and validated positions. The problem reveals itself in three predictable patterns that destroy otherwise sound trading campaigns. Most traders either set stops too tight, getting shaken out of quality positions by normal market volatility, or they set stops too wide, allowing small losses to mushroom into account-killing disasters. Even worse is the amateur's fatal flaw, moving stops against themselves when positions turn unfavorable. You've experienced this psychological trap. You set a logical stop at $48 based on market structure. The stock touches $47.90, and your brain starts rationalizing. Just a little more room. It's probably just a false breakdown. Maybe $47.50 is better. You cancel the original stop, lower it to $47, then watch in horror as price collapses to $45. Your disciplined $200 loss becomes an uncontrolled $800 catastrophe that requires 4 winning trades just to break even. This emotional manipulation of protective measures destroys more accounts than any market crash. Here's the systematic protocol using exact numbers from our pyramid example, with mathematical verification that reveals the genius of professional stop management. Initial position: 200 shares purchased at $50 with stop at $48.50, creating $300 of defined risk. After your first edition at $51, bringing total position to 270 shares at an average cost of approximately $50.26, you don't leave your stop at the original $48.50 level. Instead, you trail it systematically to $49.80, positioned just below the pivotal point that triggered your first edition. This isn't arbitrary. It recognizes that market validation has occurred, providing a new, higher structural level for protection. After your second edition at $52.50, bringing your total to 360 shares at an average cost of approximately $50.72, your stop trails again to $51.20, positioned below the most recent confirmation level that validated your latest scaling decision. The mathematics reveals something beautiful that most traders never understand. Your risk actually decreases as your position grows, despite holding more shares. Your original 200-share position risked $1.50 per share, from $50 to $48.50, totaling $300. With 360 shares and a trailing stop at $51.20, your average cost is $50.72. If stopped out at $51.20, you realize a profit of $0.48 per share across 360 shares, generating $172.80 in total profit. Your carefully built pyramid has transformed from a risky speculation into a guaranteed profitable trade, even in the worst-case exit scenario. Your total position value has grown from $10,000 to over $18,900, while your actual downside risk has been eliminated entirely. This isn't luck, it's mathematical certainty created by trailing stops behind confirmed pivotal points rather than arbitrary percentage levels. Never widen stops. This rule admits no exceptions, no special circumstances, no just this once rationalizations. You can tighten stops, you can trail them higher as positions move favorably, but you never give losing positions more room to damage your account. Use market structure, not hope, to determine stop placement. Trail below swing lows that created fresh highs, or employ a volatility measure like 1.5 times the average true range below the last pivotal point that generated confirmation signals. If the 14-day ATR is $1.20, position your stop $1.80 below the relevant pivot, not below your comfort level. The key is maintaining objectivity before the heat of real-time decision-making clouds your judgment with fear and greed. Risk budget continuity provides the framework that prevents any single trade from threatening your entire account. Cap total open risk at 1.5 to 2 times your initial intended risk per trading idea. If you plan to risk $750 on this campaign, your maximum open risk across all pyramid layers should never exceed $1,125 to $1,500. Regardless of how many confirmations you receive. This ceiling forces disciplined choices. If volatility expands and your logical stop must sit wider, you reduce position size to keep dollar risk within your predetermined envelope. If multiple pivotal points threaten to break simultaneously, you scale down preemptively, rather than hoping for salvation. The market can create violent moves, but your systematic approach doesn't have to break under pressure. Consider this scenario that tests your discipline under real market pressure. Your 360-share position sits comfortably at $52.60, with a trailing stop firmly anchored at $51.20, showing substantial unrealized profits. Suddenly, a midday sell-off triggered by random news drops your stock to $52.10, still $0.90 above your stop level, but enough to trigger emotional responses in undisciplined traders. Your brain starts questioning, should I take profits now? What if this is the beginning of a larger decline? Maybe I should tighten my stop to $52. You resist these emotional impulses, trusting your rules-based system over momentary fear. Into the close, institutional buying pressure lifts the stock to new highs at $53.20. Your discipline preserved the position for the next leg up, while emotional traders who panicked missed the continuation move entirely. This is what systematic stop choreography provides: the ability to stay in winning trades when volatility attempts to shake you out. Volatility considerations require adjusting stop distances based on each stock's normal trading behavior, rather than using fixed percentages across all positions. High volatility growth stocks need wider stops to avoid getting shaken out by routine price fluctuations, while stable value stocks can use tighter stops because unusual volatility often signals fundamental problems. Use the stock's 20-day average true range as your baseline. Then multiply by 1.5 to 2 for appropriate stop distance below key support levels. This objective approach removes guesswork from stop placement while respecting each instrument's unique characteristics. Build a decision tree before you build substantial size, removing emotional interference from critical protection decisions. If price undercuts your most recent addition's pivot and fails to reclaim it quickly, remove that layer and reassess your thesis. If the primary trend line breaks with expanding volume against your position, scale down to your previous layer's size immediately. If multiple structural levels fail in sequence, pivot points, swing lows, moving averages, execute a complete exit without ceremony or hope. On strength, only ratchet stops higher after confirmed higher lows form. Don't choke profitable trades by tightening stops into normal noise. After each meaningful price advance, schedule a brief review. Define new pivotal points, update ATR calculations, adjust risk parameters, and document your updated plan. Combine systematic stop choreography with your profit-taking thirds for maximum resilience and capital preservation. Your banked profits from the first and second third sales provide cushion against inevitable volatility, while your trailing third, protected by structure-based stops, converts sustained trends into outsized paydays. Sometimes your stop will trigger and price will immediately rebound, making you feel foolish for following your rules. Accept this outcome gracefully. Insurance premiums keep you in business over the long term. The goal isn't perfection on individual trades, it's systematic profit extraction across many campaigns while preserving capital for future opportunities. Memorize this maxim that governs all professional stop management. Protect price progress with rules, not reactions. Your stops should trail systematically based on market structure and confirmed pivotal points, never on your emotional state or daily profit fluctuations. Rules-based stop management removes the psychological burden of making protection decisions under pressure, ensuring your carefully built positions remain safeguarded even when fear and greed attempt to override your systematic approach. Your stop isn't a prediction of where price will go, it's protection against where you refuse to let it take your capital. But even perfect stops won't help if you don't understand and master the underlying psychology that makes or breaks this entire systematic approach. The mental framework that separates consistent winners from perpetual strugglers requires confronting the emotional demons that turn sound rules into abandoned guidelines when real money is at stake. Here's the brutal reality that destroys more trading accounts than any market crash. The one-third rule isn't difficult because of the mathematics. The calculations are straightforward. The triggers are clear, and the logic is irrefutable. It's difficult because of your brain. Every fiber of your trading psychology will fight this systematic approach with relentless intensity. When you're taking that first profit at one-third of your intended risk, greed screams with demonic fury. But what if it keeps going? What if this is the beginning of a 200% move and you're selling into strength like an amateur? When you're building a position slowly with test sizes, fear of missing out demands immediate gratification. Why not go all in now? You've done the research. Stop being so conservative and seize the opportunity. This internal warfare is where most traders fail, not in understanding the system intellectually, but in executing it consistently when real money creates real emotional pressure. Livermore faced these identical psychological demons throughout his career. The difference between his early disasters that led to bankruptcy and his later triumphs that generated millions wasn't superior intelligence or secret market knowledge. It was emotional discipline forged through painful experience. He learned to treat trading like a systematic business with predetermined rules and mathematical frameworks, not a casino driven by momentary feelings and impulsive decisions. This transformation required years of losses, self-analysis, and the gradual recognition that his biggest enemy wasn't the market, it was his own emotional responses to market movements. The market simply moved up and down based on supply and demand. His emotions created the chaos that turned those movements into profits or losses. Consider the psychological trap that ensnares even sophisticated traders during partial profit-taking scenarios. You've followed the system perfectly, bought 300 shares at $100, taken your first third at $101.67 for a $167 profit, and created your free ride scenario. Then the stock explodes higher, reaching $108 within days. Your brain immediately begins its torture routine. You left $2,000 on the table. If you had held the full position, you'd have made $2,400 instead of just $400. You're an idiot for following some antiquated rule instead of trusting your conviction. This internal dialogue becomes so intense that traders abandon their systematic approach entirely, reverting to hope-based position management that inevitably leads to giving back profits when trends reverse. But here's the professional mindset shift that changes everything. You didn't leave money on the table, you took money off the table. You transformed a risky speculation where you could have lost $1,500 into a guaranteed $167 profit plus a risk-free opportunity for unlimited upside on the remainder. The money you left on the table was never yours to begin with, it was potential profit that required perfect timing to capture. This reframing is essential. You secured a concrete win that can never be taken away, and now you have a psychological advantage that allows you to hold the remainder without the crippling fear of giving back initial gains. The position-building side creates entirely different but equally destructive psychological pressure. Starting with a small test position of 200 shares, when you intended to eventually hold 600 shares, feels painfully conservative when you're convinced you've discovered the next Amazon. Your research is thorough, your conviction is high, and every instinct screams to commit maximum capital immediately. The small initial position feels like you're not taking advantage of your superior analysis. But Livermore understood something crucial that most traders never learn. The market doesn't care about your conviction, your research quality, or your confidence level. It only responds to actual price action and volume patterns that reveal institutional behavior. Your job isn't to predict future movements based on fundamental analysis, it's to react intelligently to confirmation signals that indicate when institutions are actually accumulating shares. Counterintuitive wisdom that separates professionals from amateurs. Doing nothing is often the best trade you can make. When your test position moves against you by breaking below your predetermined stop level, cut it immediately without hope or hesitation. When it moves sideways, creating neither confirmation nor negation, wait patiently for resolution rather than forcing action. When it confirms with authority through sustained price advancement and expanding volume, add systematically according to your predetermined rules rather than emotional impulses. This patience isn't passive waiting, it's active position management that keeps you aligned with market reality instead of your hopes and fears. Most traders can't tolerate this uncertainty. They need constant action to feel productive, not understanding that selective action based on confirmation is far more profitable than constant activity based on emotion. Professional traders develop what Livermore called market sense, the ability to execute predetermined rules regardless of emotional noise, market volatility, or daily profit fluctuations. This isn't natural talent. It's learned behavior developed through consistent practice and painful experience. They understand that individual trades don't matter in isolation. What matters is following their systematic process consistently over hundreds of trades across various market conditions. A professional might lose money on 7 consecutive trades while following their rules perfectly, then make enough on the 8th trade to generate substantial net profits. An amateur abandons their system after 2 losses, switching to a new approach that feels more comfortable but lacks statistical validity. Here's your practical implementation protocol for developing this psychological discipline. Start with paper trades to build the behavioral habits without financial pressure that clouds judgment. For at least 30 trades, meticulously apply the 1/3 rule without any real money at risk. Practice taking profits at predetermined levels even when stocks continue higher. Practice building positions slowly, even when you're convinced you've found a winner. Practice cutting losses quickly, even when you believe the position will recover. The goal during this phase is behavioral conditioning, not immediate profits. You're training your brain to follow systematic rules instead of emotional impulses. After demonstrating consistency in paper trading, transition to your smallest possible position sizes with real money. The psychological pressure changes dramatically when actual capital is at risk, even small amounts. If you find yourself deviating from the rules, immediately reduce your size or revert to paper trading until discipline is reestablished. Master the psychology first through deliberate practice. The profits will follow naturally once your emotional responses align with your systematic approach. Build pre-commitment devices that make good behavior inevitable rather than relying on willpower alone. Write if-then scripts before the market opens. If price reaches my first target, I sell 1/3 without debate. If an addition fails to show profit within 2 sessions, I remove that layer. If the broader index undercuts yesterday's low on rising volume, I have position size across momentum names. Print these scripts and place them beside your keyboard. Check boxes, not feelings. When adrenaline spikes during volatile moments, use a simple breathing technique. Inhale for 4 counts, hold for 4 counts, exhale for 6 counts. Repeat 3 times. This resets your nervous system so your predetermined plan can reassert itself over emotional impulses. Track your psychological progress with numbers so it cannot hide behind rationalizations. Monitor rule, adherence percentage, average risk-reward per trade, error cost per month, and time spent in trades while violating your plan. If adherence stays above 85%, expectancy stabilizes even with a modest win rate. If it falls below 70%, even the best systematic method will bleed capital. This transforms feelings into measurable data. You'll discover that process consistency, not prediction accuracy, drives long-term equity curves. Journal immediately after each trading session. Record entries, exits, stop placement, risk per trade, and an adherence score from 0 to 100. Look for patterns in your rule violations. Maybe you break discipline most on Fridays, or after 2 consecutive losses, or when friends share hot tips. Then build specific guardrails. Reduce position sizes after 2 losses. Ban social media during active management. Set a maximum of 3 trading decisions per hour. Your goal is environmental design that makes disciplined behavior cheaper and easier than impulsive behavior. Market psychology creates predictable patterns that you can exploit once you understand your own psychological weaknesses. When you feel maximum confidence about a position, that's often the optimal time to take profits or reduce size. When you feel maximum fear about entering a confirmed breakout, that's typically the best entry point. When you want to abandon your system because recent trades haven't worked, that's usually when systematic approaches generate their best returns. Your emotions are usually wrong about optimal timing because they're based on recent experiences rather than long-term statistical realities. Memorize this fundamental maxim that governs all professional trading psychology. The market will always be there, but your capital won't if you don't protect it. Opportunities are infinite, capital is finite. Your systematic approach prioritizes capital preservation over profit maximization on any single trade, ensuring you can participate in future opportunities even after inevitable losses. Amateurs risk large amounts hoping to get rich quickly. Professionals risk small amounts systematically, building wealth through consistent execution over time. Remember the core distinction that separates successful traders from perpetual strugglers. Amateurs focus obsessively on being right about market direction, spending countless hours trying to predict the future through analysis and indicators. Professionals focus relentlessly on being right about their systematic process. They understand that the market is inherently unpredictable, but their response to it can be systematic and consistent. Direction is unpredictable and uncontrollable. Process is predictable and completely within your control. That fundamental difference, the shift from prediction to process, is the true secret to transforming from hoping for wealth through lucky guesses to systematically building wealth through disciplined execution of time-tested principles that have generated fortunes across every market era. Your psychology will be tested every single day you trade. The 1/3 rule provides the framework, but your mind provides the execution. Master the mind first, and the money will follow with mathematical certainty. Fail to master the mind, and even the best system becomes another expensive lesson in the cost of emotional trading. You now possess both sides of Livermore's legendary 1/3 rule. The profit-taking discipline that systematically protects gains from inevitable market reversals, and the position-building framework that maximizes exposure to confirmed trends without catastrophic risk. But knowledge without rigorous, systematic implementation remains worthless intellectual entertainment. Here's your complete action plan to transform from amateur hope-based trading to professional rule-based execution, with mathematical precision that removes emotional interference from every critical decision. The complete profit-taking protocol. Your profit-taking system operates with mathematical certainty that eliminates guesswork from your most important decisions. Before placing any trade, define your maximum acceptable risk in specific dollar terms. This becomes your reference point for all subsequent actions. When your total position profit equals exactly 1/3 of your intended risk, you sell 1/3 of your shares immediately, without debate or hesitation. At 2/3 of your intended risk in accumulated profits, you take another third off the table, banking substantial gains that can never be erased by market reversals. The remaining third receives a trailing stop position 10–15% below recent swing highs or 1.5 ATR below the most recent pivotal support level that created momentum. This systematic approach guarantees profitability on winning trades regardless of final outcomes, transforming speculation into systematic wealth extraction. Consider the mathematical beauty. If you risk $1,500 on a campaign, your first profit-taking trigger occurs at $500 total profit. Your second trigger activates at $1,000 total profit. Even if the final third gets stopped out at break-even, you've banked $500 guaranteed profit from a trade that could have lost $1,500. You've converted potential disaster into certain success through systematic execution rather than hope. The systematic position-building protocol. Position building requires equal discipline but operates in reverse. starting small and earning size through market validation rather than personal conviction. Begin with exactly 1/3 of your intended total position size, placed at or just above confirmed breakout levels where institutional accumulation typically begins. Add another 1/3 of your current position, not 1/3 of your intended total. Only after clear market confirmation through sustained price advancement and expanding volume. Each addition must be profitable immediately, or you don't make it. This rule prevents averaging down disguised as pyramiding up. Trails stop systematically below the pivotal points that triggered each addition, protecting gains while giving confirmed trends room to develop. Never average down into weakness, only add to demonstrated strength that validates your original thesis through actual price and volume behavior. Your position grows with market validation, not personal opinion. Complete integration example with mathematical precision. You identify a compelling $50 stock breaking above a 6-week consolidation base. Your analysis suggests a full position of 300 shares based on your account size and risk tolerance. Your maximum acceptable risk is $4 per share with a stop at $46, totaling $1,200 intended risk. You begin with 100 shares, exactly 1/3 of your intended total, positioned at $50.10, just above the breakout level. The stock confirms the breakout by advancing to $51 with expanding volume and institutional participation. You add 35 shares, 1/3 of your current 100-share position. At $51.10, your total position becomes 135 shares, with an average cost of approximately $50.44. You trail your stop to $48.50, positioned below the pivotal point that triggered this addition. At the next confirmation level, around $52.50, you add another 45 shares, 1/3 of your current 135-share total, bringing your position to 180 shares with an average cost of approximately $50.97. You trail your stop to $50, below the most recent confirmation level. Notice the mathematical progression. Your position has grown 80%, while your stop has moved from $46 to $50, transforming your $1,200 risk into a guaranteed small profit even in the worst-case scenario. Now the profit-taking protocol activates when this 180-share position shows total profits equal to 1/3 of your original $1,200 intended risk, $400 profit, occurring around $53.20 per share. You sell 60 shares, 1/3 of your current position. When profits reach 2/3 of your intended risk, $800 profit, around $55.40 per share, you sell another 60 shares. The final 60 shares receive a trailing stop, allowing maximum upside capture while having already banked $800 in guaranteed profits. You've successfully integrated both applications, creating a campaign that minimizes risk while maximizing reward potential. Critical success factors and behavioral requirements. 4 non-negotiable principles govern successful implementation. First, cut losses fast and small. Never allow a manageable loss to become an account-threatening disaster through hope or stubbornness. Your predetermined stop level is sacred. Honor it without question or rationalization. Second, size positions small initially, understanding that you earn the right to larger positions through market confirmation, not personal conviction. Your initial test positions should feel almost uncomfortably small relative to your account size. Third, wait patiently for clear setups that meet your predetermined criteria rather than forcing action during ambiguous market conditions. Patience isn't passive waiting, it's active capital preservation that keeps you aligned with high-probability opportunities instead of random market noise. Fourth, own your systematic process completely. Following predetermined rules regardless of emotional noise, recent results, or external opinions. Rules over reactions. Always. Implementation. Homework with specific timelines. Practice this complete system through 30 paper trades before risking any real capital, focusing exclusively on building correct behavioral patterns. Track your adherence to rules with mathematical precision, taking profits at predetermined levels, adding only after confirmation, cutting losses quickly, and following protocols regardless of outcomes. Don't focus on being right about market direction during this practice phase. Focus on executing your systematic approach consistently. Measure rule adherence, not hypothetical profits. If you achieve 85% rule adherence over 30 paper trades, graduate to quarter-size real money positions. Run another 30 trades at reduced size. If adherence remains above 85% and maximum drawdown stays below 3% of account value, scale to half-size positions. Full size is earned through demonstrated consistency, never given through impatience. Advanced risk management and behavioral conditioning cap total open risk across all positions at 1.5 to 2 times your initial intended risk per trade idea. If you plan to risk $750 on a campaign, your maximum total exposure should never exceed $1,125, $1,500, regardless of how many confirmations you receive. This ceiling forces disciplined choices and prevents any single idea from threatening your account. Create environmental design that makes good behavior inevitable, rather than relying on willpower during stressful moments. Write detailed if-then scripts before each session. If my position reaches 1/3 profit target, I will sell 1/3 immediately. If an addition fails to show profit within 2 sessions, I will remove that layer. Print these scripts and keep them visible. Check boxes based on predetermined criteria, not feelings. Build accountability through obsessive documentation that transforms subjective feelings into objective data. Record entry prices, exit prices, stop placement, risk per trade, rule adherence scores, and emotional state during key decisions. Look for patterns in your violations. Maybe you break discipline after consecutive losses or when positions initially move against you. Build specific guardrails around these patterns. Performance, measurement, and systematic optimization track. Process metrics rather than short-term profits that create dangerous overconfidence. Monitor rule adherence percentage, average risk-reward ratio, maximum drawdown periods, and time spent in profitable trades. If process metrics remain strong, profits compound naturally. If they deteriorate, address behavioral issues immediately before they create substantial losses. Your systematic approach will be tested repeatedly by market volatility, losing streaks, and psychological pressure to abandon proven methods for seemingly better alternatives. Every professional trader faces these tests. The difference between long-term success and eventual failure lies in maintaining systematic discipline during challenging periods. Your rules aren't suggestions to follow when convenient, they're non-negotiable principles governing every trading decision, final integration, and advanced development. Memorize this fundamental maxim that governs all professional systematic trading. Discipline is the bridge between trading goals and trading accomplishment. Your goals mean nothing without disciplined execution of proven principles over extended time periods. Discipline isn't willpower, it's environmental design that makes good behavior easier than bad behavior. The 1/3 rule transforms trading from speculation into systematic wealth building through mathematical precision and emotional discipline. Execute it consistently for 100 trades and your equity curve will reflect professional behavior rather than amateur hope. Your systematic foundation is now complete. If you've mastered these principles through deliberate practice and demonstrated consistency, you're ready for advanced concepts, understanding pivotal points and tape reading the precise technical signals that tell you when to apply each aspect of the 1/3 rule for maximum effectiveness. These advanced skills refine your entry timing and improve confirmation signals, but they build upon the systematic foundation you've established. Master the foundation first. Advanced techniques are worthless without systematic discipline supporting them. The 1/3 rule isn't just a trading method, it's a complete framework for transforming speculation into systematic wealth accumulation through time-tested principles that have generated fortunes across every market era.